Good evening, friends. Welcome to Adda 24/7. Hi, morning everyone. Welcome to Adda 24/7. Hi, morning, good morning everyone. So, today is a working day, right? For banking. You're having for bank today. Last time you had a holiday, isn't it? Today you don't have a holiday. Yeah. So, you'll have to go to the bank also. Good morning, good morning. Hi, hi, good morning. Parimala, good morning. Morning everyone. Good morning. Okay. Morning Danya. Good morning everyone. Okay, so today we'll be doing marathon on BFM and we'll be solving all the important case studies over here for BFM. Okay, case studies matter a lot, isn't it? Morning everyone. Sudhir, Govind. Hi, good morning Gitanjali, everyone. Good morning Saraswati. Morning. And importantly, remember the case studies which we'll be doing are the most important ones today. Why? Because we'll be doing one on horizontal and vertical disallowance. That is very important because that case study had come in June also, June exam. Okay, horizontal and vertical disallowance, number one. Number two, also we'll be doing a case study on options because that is also an important case study for BFM. Because if in ABM this options question hadn't come, so mostly in BFM there are chances that the question on options or case study or any question, it might come over there. Okay, so let's start without wasting the time. Okay, so firstly, everyone, those who are new, download Adda 24/7 app on your mobile. In this app you'll be getting all the premium study material, current affairs, job alerts, live lectures for JIB, CIB and other banking exams. Plus you'll be getting notes, plus you'll be getting question banks, everything. Okay, yeah. Case study. Today we'll be doing case study only. Okay, I know volatile section में. Yeah, who is this Shalu? Yeah, correct. सेविंग्स अकाउंट का 10% कोर सेक्शन में आएगा. ओके, नो, 10% वोलेटाइल में आएगा. 10% will come in volatile and 90% will come in core. Similarly for current, 15% will come in volatile and remaining in the core. That is how it is done. Okay, yeah. Who's this? Another query. What is the other query? Yeah, I've just answered that, isn't it? Okay, 10%. Here, everyone kindly pay attention. 10% of the savings account funds of the bank, that will come in volatile and remaining will come in core. Now what is the difference between core and volatile? Understand this first. Core means what? Which does not generally gets withdraw over here. Okay, yeah, we'll be covering case studies. Okay, chalo, yeah. Also subscribe to Officers Adda 24/7 YouTube channel. Everyone, those who are new, kindly subscribe to Officers Adda 24/7 YouTube channel now. Okay, yeah. So Officers Adda, that is in this channel you'll be getting all the updates for JIB, CIB and various other exams as such. Okay, chalo. See these new batches for the new guys. Kindly understand, these are the batches which have. This is a BFM batch which is already off now. Okay, retail batch is coming up on December 5th. Go for this batch. Okay, subscribe to the channel, everyone. Do it fast. Okay, let's start. Yeah, let's start with the first. Okay, what is this VAR question, Sandeep? Okay, definitely we will start with the VAR only today. Okay, VAR, value at risk. Okay, certificate of deposit and max period and amount. Okay, we'll do that. Hold on. Yeah, so what is the question? Firstly, before starting this series, let me see the questions first. What are the questions asked? Please clarify about the certificate of deposit, minimum and maximum period, amount, and okay, we'll do that. Okay, what is the next one? VAR, value at risk. Okay, we'll start that only. Value at risk. Okay, let's start with the questions. First question is on, here we'll be solving all the numericals now. Okay, all the numericals. So let's start with VAR today. Okay, okay everyone. Chalo, good morning, good morning. If the daily volatility of a security is 2%, how much will be the monthly volatility of the security? So here, always one important point about volatility. Everyone understand one simple concept. Okay, how to find out the monthly volatility, weekly volatility, or anything? Always first what you have to do is start from. Always move on to step number 1. First is find daily volatility. Let it be anything given. Daily volatility first find, and then move on to the monthly, weekly, whatever is asked. Your base is daily volatility. Okay, your base is daily volatility. Now in this question, luckily they have directly given daily volatility is 22%. Then how much will be the monthly volatility? In this case, see here, when it's given 2% daily volatility, find a monthly. So formula is very simple. Now for monthly volatility, it is equals to, see this, daily I'll write this D into square root of 30. Okay, so what is the daily volatility given? It is 2%. So 2 into square root of 30. So square root of 30 is what? 5.477, isn't it? So 2 into 5.477, that is 10.95%. That is a monthly volatility. Now what do you mean by this? Understand this concept. What do you mean by this monthly volatility? That also you need to understand. See this. It means that, suppose if, see this is my stock price. Okay, this is my mean stock price. Let's say it is 100 rupees. Okay, so it means that in a month this stock will, or this commodity, why only stock? This can be months. Okay, so depending on, here, now again one important question: should I take 30 days or 25 days? Okay, if it is not given in the exam about number of days, take as the number of days as you get, means 30 days. But if in the exam they mention that the volatility, the number of days in the month is 25, then take only 25. Got it everyone? See here, it depends on what is given in the exam. If in the month they mention that the number of days in the month is 25, then only take root of 25. If they don't mention the number of days, take whatever days you feel, means whatever are the monthly correct days. Okay, so that is root of 30. Got it? But what is this volatility? It means here, if the stock price of or any commodity price is 100, then in a month it will fluctuate by 10.95%, means it will go up by 10.95% this, and it may come down by 10.95%. So either here or here. That is the meaning of this word volatility. Okay, got it everyone? Got it clear? Yeah. Doubt in substandard RSV is more than 10%. Do we have to differentiate secured and unsecured, fall or not? Okay. So here we'll do that. Once the topic comes, we'll do this substandard, standard. Okay, we are having that. Okay. Let's move on. Hold on. Yeah. Once again, let me correct this slide a bit. Okay. Yeah. One second. Yeah. Got it? Yeah. Now it is okay. So this is volatility done. Now this means that it may go up or it may go down. So depending on this volatility, if they ask you, I'll tell you, if they ask you variance, then what? If they ask you variance, whatever is the volatility figure, see here, remember one important part. Volatility can also be called as standard deviation. It can be asked as SD also, standard deviation. Okay. Now if they asked variance, then what? If they ask variance, then it will be the square of this. Okay, variance is always the square of standard deviation. Okay, got it? Okay, let's move on. If per annum volatility is 30% and number of trading days per annum be 250, how much will be the daily volatility? See here, now what is it given? Number of days are given over here. Okay, and also per annum volatility is given as 30%. Now they are asking daily volatility. So use again the same formula. What is the formula? Okay, let me remove this first, whatever is not needed now. One sec. Our target is always to find a daily volatility first in anything. Okay, first target your daily volatility. Now let's find it over here. See this. Per annum volatility is given as 30%. Number of days per annum is 250. Find the daily. Okay. So per annum is what? Annum equals to, I'll write it over here. Annum equals to daily into number of days, square root of number of days. What are the number of days? 250 it's given. Okay. And what is the annum volatility given? 30%. So 30% equals to 30. We won't write percentage now. Okay. D into square root of 250. Right. If it is given in the exam, that we should take it 250 or 365 or what. If it's given in the exam the number of days, then take that only. Okay. So what is the square root of 250 now? It is 15.81. Correct? It is 15.81. So 30 equals to D into 15.81. So D becomes what? D equals to 30 upon 15.81. So it is 1.90. Okay. 15.81. So 1.90. Okay. So daily volatility becomes 1.90%. Got it? What does it mean? This means that if this commodity is moving, means fluctuating in the year, deviating in the year from 100 rupees, in the year if it's fluctuating by 30%, then per day it will fluctuate by what? 1.9%. Like this, 1.9 here, 1.9 here. Okay. And in the year it is fluctuating by 30% over here. Now they may ask you weekly volatility also in this question. So what is the simple answer? If they ask you weekly, give me the answer for weekly volatility. If they ask you, give us the weekly volatility in question number 2, then what will be the answer? Daily you have already got it, 1.9. So find out the weekly volatility now. Weekly volatility will be weekly equals to, I'll write it over here, weekly equals to daily into whatever the daily volatility is, daily into square root of what is week? 7, right? So then find 7, square root of 7. What is square root of 7? Square root of 7, one sec, let me get the calculation over here. Okay, yeah. So now, yeah. So daily volatility is what? 1.91, right? So 1.91 into square root of 7. So what is square root of 7 now? 2.64, right? So 1.91 into 2.64. So the answer is 5.05. So if they ask you weekly volatility also, then also you can definitely solve it. 5.05. Okay. Main target is your daily volatility. Main target is daily. Okay. Move on. Chalo. 1 day VAR of a portfolio is 50,000 with 97% confidence level. In a period of 1 year of 300 days, how many times the losses of the portfolio may exceed 50,000? Now what do you understand from this question? See this, 1 day value at risk of a portfolio is 50,000. 1 day VAR is given, okay, with 97% confidence. So 97% confidence means what? Now that is important. What is 97% confidence? See this, it means that, look at this, what am I telling you, okay? 97 confidence means loss may exceed the given loss, that is 50,000, on 3 days out of 100. Now what do you mean by 3 days out of 100? See this, 97%. Percent means always it is for what? It is for 100. So out of 100 days, now look at this, out of 100 days, 97 days, the loss for my value at for my portfolio will be 50,000. For 97 days, the loss will be less than 50,000, less than 50k. I'll write it k over here now, okay? So for 97 days it will be less than 50k. But what about the remaining 3 days? Okay, 100 minus 97, so remaining 3 days it will be greater than 50k. So this is my worry. When whatever is in my hands is not my worry, never my worry, right? So what is my worry? Whatever goes out of my hands. So if it is 3 days over here, 50k it is 3 days, okay? So for 100 it is 3 days. What is given? In a period of year of 300 trading days, for 100 days my loss goes out of my control in 3 days. So for 300 days it will go in what? 3 into 3 into 300 upon 100, right? So 9 days. So for 9 days, the total loss of my portfolio will be exceeding 50,000 in a year. Now in a year, if they give you that number of days as 300, then you will get this answer, okay? But now I'll ask you one other question. If the number of trading days in the year is given as 250 over here, everyone 250 days, 250 days, okay? Then what will be the answer? Who can give me the answer now? If the number of trading days is 250, then what will be the number of days on which my loss will exceed 50,000? In that case, what is the answer? 100 is what? 3. So 250 days, 250 into 3. So 7.5 days, right? So in that case, it will be 7.5 days. Correct? Got it, everyone? 7.5 days. In what case? If the number of trading days is given as 250, right? But here in this question, what is it given? It is given 300. Okay, got it clear? Move on. Okay. Now we'll come to the important case study. Everyone pay attention. Those who have been right now doing anything very fast, now go slow for some time. Okay. Why? Because this topic of horizontal and vertical disallowance, you guys need to understand first. What do you mean by disallowance? What do you mean by allowance? And once you understand it, only then you should target this topic. Okay. Remember, June they had asked you 1 or 2 questions on horizontal and vertical disallowance. June. Okay. Very difficult one. Understand? You might have read, many of you might have read something about this in the books, right? Have you read it in the books? Horizontal and vertical disallowance. Anyone has read this? Yeah. Okay. So here, what is this disallowance? Firstly, tell me what is allowance. Okay. What is allowance? And once you understand the word allowance, okay, then you'll understand the word disallowance, right? Allowance means what? It means that, suppose if I tell you, I allow somebody to come into my house, okay, or allow somebody to come into my city, okay. So that is allowance. What is disallowance? I don't allow somebody. So that is basically, this is a negative concept, okay. Vertical disallowance, horizontal disallowance, okay. Disallowance means I am not allowing somebody. That is the meaning of this, not allowing, okay. So let's move on now. Change in interest rates for the assets and liabilities are different in same time band or different time bands. Now what do you mean by this? Change in interest rates for the assets and liabilities are different in the same time bands or different time bands. Now what do you mean by this? Now let's understand this from RBI's perspective. RBI's perspective means what? Okay. What are the bonds which we generally face in the banking system? Means you generally hear about those bonds. What are those bonds? Okay. Those bonds are generally 1 month or less, right? Then 1 month to 3 months, 3 months to 6 months, 6 months to 12 months, right? These are the general bonds which we see. Now what are these bonds called as? Okay, let me get the answer from you guys now. Okay. If any bond is up to 12 months from the government of India, okay, so these bonds are generally called as what? If any bond is less than 12 months, these bonds are generally called as what? These are called as, everyone, less than 12 months, right? Remember, there are 3 types of bonds from government of India, mainly, okay, 3 types of bonds. Which are those? One is, I'll write it one by one. One is CMB, we call it CMB. CMB means cash management bills, okay. CMB, cash management bills. Now what are cash management bills? Cash management bills means those bills or those bonds. It's, after all, everything is a bond, okay. So where CMB is cash management bills, these are less than 90 days, okay, 90 days. Then after that, from 91 days to 364 days, means 1 year. What comes in is, what is the second one? Then it comes is T-bills, correct? After CMB, what comes is T-bills, treasury bills, right? T-bills. So these are from 91 to 364, right? 364. And after 364, what we get is known as dated securities or dated bonds, we call it dated, okay? Long-term bonds, dated. Now these dated will be from 1 year to 40 years, it can be 1 year to 40 years. It can go up to 40 years, okay? Generally it goes from 1 year to 10 year, okay? 1 to 10, but it can go up to 40 years also, okay? Do you know there was some Saudi Arabia, okay? Saudi Arabia country. They have one company that's called as Aramco. Aramco is a major company in oil, okay? 2 years back, Aramco had planned to issue the bonds of how many years? They had planned to issue the bonds of around 90 to 100 years. 90 to 100. Of course, that plan failed later. They didn't issue the bonds at that time. But dated securities can range from government to government, okay? Various governments. Here, government can change it from 40 years to 100 years also someday, okay? So move on now. We are not into this business now, okay? Our point is something different. Vertical and horizontal disallowance. Here, the point over here is, if I am in the, what I mean by disallowance over here. Suppose if I want to match, now, okay, one more point. What are the types of options available in the bonds? There are two options available. One is always call option and second is always put option, right? Put. So call means what? If you expect a commodity to go up, it is called as call. We'll write it plus, okay? Then you buy this call option. What is put option? If you expect the commodity to go down, then you buy the put option, okay? So bonds are also of these two types only, having these two options, okay? So now, what does it mean? Suppose if I'll take this zones here, what has RBI done? RBI has divided it into 3 zones: zone 1, zone 2 and zone 3, okay? What is zone 1? It is from 1 month, means less than 1 month, to 12 months. This is first zone. Zone 2 is 1 year to 3.6 years. Look at this figure, 3.6 here. You have to remember this figure, okay? 1 year to 3.6 years. And zone 3 is 3.6 years to further. Means it can go to any figure out, okay? So now you have to remember this figure. I'll tell you, see here, this is very important. Less than 12 months you'll have to remember, means 1 year you can call it, 1 year, okay? Less than 1 year, 1 year to 3.6. Look at this figure, it's not 3 years, it's 3.6 years, okay? And then greater than 3.6 years. You have to remember it at any cost, okay? In exam, this table may not be given to you, because this is a table given by RBI to all the bankers, okay? General thing, okay? So now what does RBI say? RBI says that whenever you have to adjust two bonds, now look at what am I saying, okay? Whenever you have to adjust two bonds within the same zone, okay? Then the disallowance means you can't allow them to adjust it up to what figure? Up to 5%. Within the same zone, if I have to adjust two bonds, so I can't adjust 5% of that. Means what? I'll explain you further, okay? It means that suppose if I am having one bond of, let's say 4 months, one bond of 4 months, bond number 1, 4 months, okay? And second bond I am having it of, let's say within 12 months only we'll take it, so let's say 8 months, okay? So one bond is of 4 months, second bond is of 8 months. So if I have to adjust these two bonds here, and what is the important criteria of adjustment? Everyone's here. Are you getting this up till now? Type yes if you have understood up till now. What have I told you about the zone 1, zone 2, zone 3, these 3 parts? Have you understood it up till now? Zone 1, zone 2, zone 3, okay? Type yes if you have understood it up till now, then I'll go further. Otherwise what happens? I'll go on and on. And many of us have not understood this zone only. Then what's the use, right? So have you got it, everyone? Zone 1, zone 2, understood the difference between these zones, okay? Less than 1 year, 1 to 3.6 and greater than 3.6, okay? Now if I have to adjust these two bonds, one very important criteria is, can you adjust plus bond with plus bond in your normal life also? Can we adjust plus bond with plus bond? Never. What do? We adjust plus bond with minus bond. So whichever bond is having the call option, that can be adjusted with the put option only. Whichever bond is having the put option, that can be adjusted with the call option only. Two bonds with the call option can't be adjusted. Means what? Suppose I'll give you an example. If there is one bond with a call option of 1 month and second bond with again the call option, okay, so I can't adjust these two bonds. If I am having one bond with call and second with put, then I can adjust it. Okay, understood this? Type yes if you have understood this, so that I can go ahead. Okay, so that I can go ahead. If I have one bond with the positive sign, the other bond should be of the negative sign. Only then I can adjust it. Now this is between the same zones. Here, what are the examples I have given? One is for bond number 1, second is this bond number 2 of 8 months. So both are within 12 month zone. See this, within 1 year zone. So when you adjust these bonds within the same zone, now look at this sentence, what am I telling you? When you adjust these bonds within the same zone, okay, then it's called as vertical disallowance. Okay, when you adjust the bond within the same zone, see here I have written it over here. Vertical difference in the same time band, same zone, okay, then it is called as vertical disallowance. And when you adjust the bonds between the different time zones, then it is called as horizontal disallowance. Okay, so over here, see this, if I adjust this bond of 4 months and 8 months, it is called as vertical disallowance. See this table is for vertical, because see this, 5% is for what? In this zone 1. This 5% is for what? This zone 2. And this 5% is for this zone 3. So it's for within the same zone. Okay, whenever we adjust within the same zone, it is called as vertical disallowance. And when I adjust it in different zones, zone 1 and zone 2, very important, everyone keep everything aside. Focus only on whatever I am telling you. Okay, focus only on that. Very important part. You might not have read it anywhere else in the books also, and even if you have read it, it never goes into our head. Okay, so whenever we adjust anything between the same zone, within the same zone, it's called as vertical disallowance. Got it everyone? Vertical. Now we'll go to horizontal. Got it? Type yes if you have understood vertical. Okay, move on. Now zone 1 and zone 2 if I adjust, means what? Suppose if there is one bond of 4 months and second bond is of, let's say, 2 years. See this, instead of 8 months now I will do 2 years. Okay, but again the condition is same. Whenever I have to adjust bond 1 with bond 2, let it be in the same zone or let it be in the other zone. The main condition is what? One should be plus, other should be minus. Only then you can adjust it. You can't adjust plus with plus. You can't adjust that. Okay, got it? So now, if I have one bond with 4 months and other bond with 2 years, look at this everyone. So then, what will I be doing? I'll be adjusting in zone 1 and zone 2. So what does RBI say? When you adjust between the two zones, the disallowance is 40%. I'll tell you about the disallowance figure also, 40%. Here, these are the figures given by RBI. You have to remember these figures. 5% is within the same time zone. 40% is between the adjacent time zones. See this, zone 1 and zone 2 I am adjusting. Zone 1 and zone 2. See here, these are nearby neighbors, isn't it? So neighbors have got a 40% disallowance. Similarly, zone 2 and zone 3. If I adjust a bond between 2 years and let's say what, 5 years over here, okay? So if I adjust a bond between 2 years and 5 years, then 40% is a disallowance. But again the criteria same, plus minus, okay? Now the third part, 100% means what? If I adjust the bond between zone 1 and zone 3, see this, you are not a neighbor now. Zone 1 and zone 3 is not a neighbor. Then whatever I'll have to disallow is 100%. Disallow, understand the word, what am I telling you? Disallow. Now I'll come to this percentage, 40%, what is this, 100%. You just remember these figures now, okay? Whenever you are not neighbors, zone 1 to zone 3 I am adjusting, then it is 100%. Got it everyone? Now what is this figure, 40%, 100%, given you have remembered everything, it's okay. But what is this figure? It means that, suppose let's say this bond, one bond is of value, let me give the value, I'll giving some hypothetical values. let's say the bond is for 100 crores, okay, 100 crores over here, and this bond is of, let's say, 50 crores, okay, 50 crores. Now what should be considered? Okay, let me rub this, whatever, because what happens, otherwise this screen becomes too much bulgy. Oh, shall I rub this now? CMB, isn't it? I'll rub this now, because this you have understood by now. Okay, let me go over here. Yeah, by this. Okay, now let me go to the problem. Suppose, see this, if the call is given as 100 crores, okay, means one bond is in within the zone 1 of, let's say, what, 3 months, say 4 months, okay. Second bond is for 2 years, and that is 50 crores. One is with call, other is with put. Then I can adjust it. So 100 and 50, okay, 100 is plus and 50 is minus, because 50 is with put. So what is my adjustment? What do you mean by this adjustment? Here, what will I do? Keep it very simple. Very simple. Simple plus minus. What will I do? 100 plus 50 minus. So it is 150. What is the difference between them? 150. I'll write it over here now above. Okay. It is 150. So 150 crores is adjusted between this bond 1 and bond 2. Got it? Yeah. Between this bond 1 and bond 2. Yeah, I'll answer that. Sandeep, I'll answer that. 12 months, na? What is it for 12 months? Yeah.